Who's sitting here has joined the Axis family as Group Executive and Head Retail Banking. We have also added key talent in areas of retail risk and operations excellence over the last 60 days. While the unique culture of Axis has always been the bank's strength, there was a need to focus more on accountability, meritocracy, sharper differentiation and reward structure, and rigorous tracking of performance and execution. With this in mind, we have reoriented the organization structure, which we shared last quarter, on both the retail and the wholesale side, that will now allow us and enable us to streamline and simplify our functioning and bring a sharper focus of our products to our banking customers on both retail and wholesale side. Deposit growth is the key challenge for all banks in the country today. With that in mind, we have created separate verticals in the retail banking side, with one side focusing on existing to the bank customers and one side focusing on acquiring or acquisition of customers. In retail lending business, the team is now organized with a product-focused structure and into smaller but larger number of regions to drive greater focus and ensure better control, and also obviously to work on deepening of our customers. We have also reoriented the wholesale business. The credit underwriting function has been taken out from the businesses and has been made into an independent function. The Chief Credit Officer now reports to me. The number of segments in the coverage group has also been expanded to again bring a sharper focus into some of the areas you are not present in. One of the areas we talked to you about is the mid-market corporate group, which has been formed and is alive and functioning as we speak. At the same time, we have also embarked on our mission to create this one Axis ideology for the bank and its subsidiaries, which focuses on projecting the bank's various subsidiaries together as one that can offer a full suite of services to our customers, to our customers in both retail and wholesale side. The focus for our subsidiaries would, as I mentioned last time, would be to attain size and scale, and we would continue to invest in them over the next couple of years to reach that scale which we want them to. Aligned to our focus on embedding conservatism in our internal policies and practices, we are looking to move towards a more conservative view on provisioning, and Jairam will share that with you, and compliance and risk. In the corporate book, we are systematically improving the standard provisioning by following a formula-based approach, and Jairam has the details, for putting aside provisions on weak standard assets with no subjectivity involved. We have also provided for a large non-banking asset and security receipts on our books during the current quarter, as we had indicated to you all during our Q3 interactions. We need to do a lot more in terms of strengthening our core operational processes and back-end. We need to institutionalize quality management practices. We need to upgrade our core technology to prepare for a digital world. We, as shared with you last time, intend to set up a digital banking practice that works back from how banking might look at 5 to 10 years from now on. We have identified the leader. The leader should be joining us in the next 60 days or so. Currently, that individual is on gardening leave. So I'm just happy to share that, as promised to you, we have done that bit too. Continuing from there, we remain focused on a predictable delivery of our numbers on growth and profitability across the Axis franchise. We intend to improve our cost efficiency and build cost consciousness across the bank. Some early signs of progress on this front are also already visible, and that will be evident in the numbers. The quarter has been a good starting point, but we have a lot more to conquer and achieve. With that, let me hand over to Jairam to take you through the bank's financial performance in the quarter in detail. Jairam.
Thank you very much, Amitabh. I'd like to start by just talking about a few sound bites that capture the essence of the kind of quarter Axis had in the fourth quarter. The bank, from an asset size perspective, crossed 8 lakh crores during the quarter, so an important milestone for us. The bank has now also delivered double-digit ROEs for 2 quarters in a row. Hopefully, it sets the baseline. We have mentioned to you that over the next 3 years, we want to reach a sustainable 18% ROE. With the second half of this year, consistently delivering upwards of 10%, we believe it provides a good base. So that's number 2. Number 3. 2023. From a network perspective, we crossed 4,000 branches. That is another important milestone for us. We ended the quarter at 4,050 domestic branches. On provisions, NPA provisions were the lowest in the last 12 quarters in this quarter. Also, correspondingly, PCR or provision coverage ratio at 77% was also the highest in the last 12 quarters. The net credit costs, i.e. credit costs net of recoveries we get from write-offs, was also the lowest that the bank has seen in the last 12 quarters. So a whole host of milestones for the bank in this quarter that we are very happy about. In terms of the core underlying performance, the big story at Axis this quarter has been strength in the core operating profit engine. NII has grown very strongly at 21%, and we ended the quarter at 5,706 crores of NII. Margins were stable. We were at 3.44% margins. Fees grew 23% YOY, another area of great strength. And importantly, an area that Amitabh has been highlighting over the last quarter, the area of OPEX, where we have said that we want to bring in much greater efficiency in the way we operate and create more favorable operating jaws. We were able to deliver that. After 2 years of negative operating jaws, i.e. growth in revenue was slower than growth in OPEX. This year, we have turned the tide again. Growth in OPEX in the financial year FY19 was lower than the growth in revenue. So we've created favorable jaws. So that's been an important story as well. OPEX for the quarter grew 10% YOY. Putting it all together, the operating profit grew 37% year on year. So that makes overall for a very strong core operating engine. As far as provisions are concerned, I mentioned earlier that we made NPA provisions of 1,700 crores during the quarter, which was the lowest we have had in the last 11 quarters. But we also made a whole host of other provisions on top of that on the lines of the conservative provisioning policy that Amitabh has been referring to. You might have seen this in the press release as well. There are 4 main aspects that we have called out. First, we increased provision coverage ratio by 200 basis points during this quarter. Second, we made a higher level of standard asset provisioning for some sectors that we newly deemed as stressed during the sector, and some of the sectors that have been in conversation in the press as well. We put them as a stress sector and made significant incremental provisions, 160 crores of incremental provisions for some of these sectors. We moved to a more standardized process for additional provisions in standard assets that have demonstrated some early signs of weakness. So we put some money away for that. And then on non-banking assets, there was a parcel of non-banking assets that we have been carrying, that we have been talking to everyone about over the last few quarters, against which we made another significant provision as well. Put all together, these items, we have made about 1,300 crores of provisions during the quarter, which do not form part of the PCR calculation. So while the provision coverage ratio itself has increased by 200 basis points, there's this whole other host of provisions that we have made which are not part of provision coverage as well. So we've strengthened the balance sheet quite significantly during the course of this quarter. Overall, asset quality metrics have improved quite substantially during the quarter. Both GNPA ratio and net NPA ratio fell for the 4th quarter in a row. GNPA now stands at 5.26% and net NPA stands at 2.06%, down substantially QOQ. The BB and below corporate loan pool, which we have indicated in the past, continues to form the bulk of where corporate slippages are coming from, fell again by about 2% on a sequential basis. It now forms 1.3% of the bank's loan book, the lowest it has been for a very, very long time. The deposit side of the business had a very strong quarter. We had 21% growth in CASA and RTD put together. The retail term deposit side of the business continues to be the core strength as far as deposits are concerned. And because of that, and because of the liquidity that it provides us, we have been able to grow the domestic loan side as well quite substantially. Domestic loans at the bank grew 18% YOY, significantly higher than where the market's at. Overall loan to deposit ratio as well moderated, to 90%, given how strong the deposit performance was. Final point on capital adequacy. The bank's capital adequacy overall is at 15.84%, with common equity tier 1 of 11.37%, so substantially above, almost 400 basis points above where regulatory minimums are, and hence have a lot of room for us to continue to deliver this kind of growth. So that's been the performance of the bank in this quarter. Another solid quarter, which gives us a good foundation on which we can embark on the 3-year execution strategy that we shared with you last quarter. With that, we come to the end of our comments. We'll be happy to take your questions.
Could you clarify on the divergence note that you've given? So the divergence are below 15% and therefore do not have to be reported or disclosed?
Yes, the RBI guidelines that say that if divergence in provisioning is less than 15% of last year's operating profits, or divergence in NPA recognition is less than 15% of last year's GNPA, you don't need to make a disclosure. That's what we have done. You might recall, though, that last quarter we did talk about the divergence before the new regulations came in. We did talk about it. Our divergence numbers were minimal, less than 1%. So we had made about 160 crores of extra provisions, and no incremental NPA had come because of divergence.
RBI has also asked banks to disclose in their notes to account any exposure they have to IMFs and the provisions that they hold. I'm assuming it kicks into effect immediately. So
yes, you will see it in the notes to accounts that will get released when the financial when the balance sheet is released. But we can tell you there's no secret here. Our overall exposure to ILFS, we've talked about in the past, overall has been roughly around 800 crores, of which about 300 crores is NPA. The amount that would have become NPA as per IREC norms, but has not been deemed NPA because of the NCLT guideline, is minimal. It's about 14 crores. Overall, about 50 crores.
just one thing, IMFs, you said overall exposure is 800 crore and NPA recognized already is 300.
Yes.
So there's a small amount that you're saying which has to be recognized.
Yes, correct.
Also,
Correct.
a small question on in front of IMFs again. NCA has today, the NCLT Mumbai kind of filed a contempt against Axis for disposing the assets without permission. So on that, you would like to?
We cannot make any comments on very late breaking.
So we have all been reading the board
We'll have to
meetings. We
see.
heard something is out there. We haven't got the details as yet. It's very difficult to comment what that is all about. Yes.
What are these new sectors where you're seeing stress, on account of which you made these excess provisions?
See, this is not in the public domain. Let's just say that these are sectors that you've all been writing about, talking about on. We cannot confirm. I apologize.
Sorry, on the IMF side, what was the provisioning number?
50 crores.
You're talking about these land parcels here in the results, but just to get some sense, you said that you've been carrying this on your book for a while and now you're providing for it. But essentially, this is because the ownership of the land is still under dispute.
No.
We had taken these parcels of land in lieu of certain loans, which have been in our books for a certain period of time. We thought we had 7 years to dispose it off. RBI has come out with a disposition saying that you need to provide for it over a 4-quarter period. That's exactly what we are doing. No, these are not disputed lands. We have full control of the land, and we can sell it if we get the right price. So that's not the issue at all.
Yes.
About 2,000 crores?
Yes. You will see it in our previous year's annual report disclosed in the non-banking assets category, roughly 2,100 crores.
That's
we provided 25% in this quarter. Yes.
Yes.
Yes, because we made a new provisioning policy this time. Amitabh mentioned this, a formula-driven policy for weak standard assets that has replaced the old, slightly more subjective contingent provisioning policy under which we had made the 600 crores.
So what we have done is we have now come out with a policy signed off by the audit committee and RBI, which says that based on a certain formula on our standard assets and some of the BB and below book, we will start providing a certain percentage number, and that will keep moving up and down based on whatever those numbers are. So it's all formula driven. So we have come out with a formal policy, got it approved, and based on that, those are the numbers which are. So we obviously revert the contingent provision because it's no longer valid, because it's not based on a formula, it was just a general contingency provision which was made.
It's been reasonably broad-based. We've seen some interest from cement, iron and steel, telecom, petrochemicals, for example. So it's been reasonably broad-based. We've also seen some selective exposure increase to the NBFC sector as well. It'd be a mix of that. It'd be a mix of term loans and working capital.
Our share of working capital has been increasing gradually, slowly. I mean, so we have been saying for some time that we've been pivoting the wholesale bank to more working capital than before. It has been growing at a certain rate, not very rapid rate. So yes, the share of working capital is growing, but it's still not that large.
But NBFC, as you said, there's an increase in the exposure to NBFC.
Yes, there is some increase in exposure to the top-rated NBFC. So
Is there some kind of a number that you think that
we don't
No,
share
we
that
don't
data
share
with
that
each other.
In terms of these double B and below rated assets, you said it moderated a little bit by 2% during the quarter. When do you see these loans eventually going fully to the NPA pool, because a lot of your slippages are coming from there?
No, Vishy, if you recall, there is a slide that we put in our earnings presentation which shows over the very long term, over the last 10 years or so, how large has been the double B and below book as a percentage of the corporate book. So historically, we have seen that we always have about 3% of the corporate book in the double B category. When we started getting into some of these asset quality troubles, that ratio lifted all the way up to almost 13%. And since then, it has come down, and we ended this year at 4% of the book being double B and below. So it is likely to reduce some more, but I don't expect that to go down to zero. It'll probably moderate at around the 3% levels that we have historically seen.
Probably the next quarter, then your corporate slippages numbers will come down, because the contribution from the
Well, on a sequential basis, I'm not so sure. See, we already had a very, very low slippage number in this quarter. Net slippages are 630 crores, for the full bank. So the numbers are so low that, at this point of time, continue to expect sequential moderation in net slippages is probably a bit much.
So how are you netting?
So basically slippages, so gross slippages, which are about 3,000 crores, minus all the upgrades from NPA. So NPAs that become standard assets.
Compared with the rest of your peers, your PCR ratio of 77% seems a little more than just conservative. Could you explain us the rationale why you choose to hold this kind of coverage?
Ritu, if you see historically, we have been at times at 80%, 81%. Axis at its peak used to be 81% provision coverage ratio. It's through some of these asset quality cycles that provision coverage has fallen and has come down to, went at its bottom to 60%. Since then, as some of our own sort of internal earnings ability has improved and some of our policies have gotten tighter and tighter, as well as the accounts that have gone into NPA have aged over time, it has become both possible and necessary for us to continue to increase provision coverage. We are at 77%. It might even drift up a little bit more before it stabilizes.
I thought you will congratulate us for doing this, increasing the coverage ratio. Sorry.
No, it's capital locked up. But to what extent do you see it rising to from 77%?
We are not guiding on that.
Okay, any guidance on credit costs since you're starting the new year?
So we're not providing specific credit cost guidance for the year. What we will say is sort of reiterate what we said in the execution strategy, which is 3 years out, we expect to be below our long-term average.
What is that?
100 bits.
You've got this model on board for the retail banking business now. Is it time for Axis to sort of open up and get customers in terms of your unsecured retail loan growth, which is what a lot of other banks are doing? Open up and get customers from outside the banks also. I assume that the focus is still within the bank to push your unsecured growth.
Well, I mean, I'll ask Pralay definitely to add what I'm saying, but we are quite clear in our minds that our existing to the bank customer strategy has worked for us. Our quality of portfolio is perhaps one of the best in the industry, and we also at some level are continue to be, while the retail performance or credit performance has been great, we also need to be cautious about what it could become over a period of time. So we would continue to focus on our existing to the bank strategy, but at the same time, there are a number of customers which are known to us who necessarily are not our savings account customers, but they are customers of the wider bank franchise, and we can continue to engage with them and sell our other products to them. So rather than going for a completely new to the bank, we would like to go and extend some of our products to some of those customers as we move forward. And there is enough out there to be able to grow at a decent pace. But let me ask Pralay to
Absolutely. I
speak.
think today, with the kind of digital interventions you can have, and the kind of credit scores you can get about customers and other behavioral traits, etc. You get a lot more information about customers. So what used to happen 10 years back about existing customers, those don't necessarily hold good anymore. So we will build partnerships. We will have our own subsidiaries and other group companies where there is a lot of customer base we can leverage on. And beyond that, also we're looking at opportunities by which A, will not take any risk. At the same time, how to get those customers, because it's not only just, as you said, it's just not only unsecured business, but it's also an opportunity to get other businesses like liability, cards, payments, so many other businesses. So we will continue to look at that, but not necessarily take risks.
I mean, we also do want to emphasize the fact that our penetration on our existing customer base is quite low in comparison to a lot of the other peer banks. So there is huge headroom for growth even in our existing customer base. So why, it works for us.
Is there any conversation with Bain Capital at this point with respect to converting their warrants into equity?
We don't need to have much conversation. Their warrants are so much in the money that it's probably will get converted. But it's a question for them to answer as shareholders, not for us as management to speculate on. They do have time till. See, the warrants expire around the 26th of June, if I'm not mistaken. So over the next 6 weeks, they will need to do what they need to do.
Another news that is always we keep asking you about is Max Life. Any progress on that front? And we understand that you have to create a operated holding company structure. We understand you have your partnership on till 2021. Anything you could tell us if you're looking to extend that partnership or talks about acquisition in progress?
So we have nothing to share at this stage. If there is something to share, we'll definitely come and be the first ones to share. We keep having all kinds of conversations with all kinds of parties, and we will obviously do what is the best for the bank. Right now, we have nothing to share. So some of the articles which are being talked about are pure speculation in our mind.
Well, have you engaged with them at all since you joined Axis Bank initially?
As we said, we engage with all kinds of partners, and Max is our existing partner.
Yes.
Obviously, we engage with them on a daily basis because we are selling their products.
And
But
do you intend to
no,
extend your partnership beyond 21?
no, there is absolutely no discussion on that at this point in time. It's too early.
Cybersecurity was one of the heads that you were talking about. Cybersecurity was one of the heads you were talking about in terms of reorganizing the organization. In terms of what is happening with credit cards, credit card fraud, there was a recent report by CIC which said that credit card frauds have doubled. How do you see that impacting your business? What are you doing to avoid the situation?
So obviously, we are monitoring this business extremely closely. Again, I'll ask Pallai to add if he wants to, but we are monitoring this business very closely. We are monitoring the data on our credit cards very closely. Our cybersecurity team is in touch with various agencies, including our partners, to keep evaluating and exploring if there are teams of people out there who could be looking to, do credit card fraud on a large scale. I think we have a pretty strong credit card team in place. But, end of the day, it's a question of, time when you're going to get attacked. It's not that whether you'll get attacked or not. But obviously, we have to be top of it, and we also have to ensure that as and when it happens, we can control it and contain it as quickly as possible. So, yes, it's an important agenda item, which is obviously, the board is seized of it, and we keep talking to and engaging with them on what are some of the measures that you are taking to ensure that this does not become a problem. But Pallai, you want to add?
Absolutely. It's just not credit cards. I think it's basically transaction monitoring across all payment system and the larger ecosystem in the bank. So we have very strong processes systems, and we have the best systems in the world which monitors this kind of processes. So I don't see that, and generally fraudsters, what they do is they attack the weaker ecosystems. So because they are the benefits are more. So we don't think that we become necessarily the targets, but we will continue to invest and continue to focus on that front.
One specific data comment I'd make is that the 2x in fraud rate in card transactions that you mentioned, our data is not that. Our customers' card transactions continue to be 6 basis points or lower, so very much in control. It is not going to 2x.
So we had said last quarter that right now we don't see any need for capital for the next 12 months. We said that in January. We continue to maintain that stand, that we do not see any requirement for capital at this point in time. Obviously, when we are trying to raise capital, when we decide to raise capital, we will again share it with the markets. But at this point in time, our stand remains the same.
As far as the bond markets are concerned, of course, as a bank with a growing loan book, you will continue to raise bonds as and when required. So we have sought approval from the board today for raising bonds, and we will be putting it to shareholder approval later. Yeah, so what we are saying on loan growth is, even though we don't have specific sort of targets that we are going after, we will continue to do what we have done over the last few years, which is our domestic loan growth we'd like to keep about 500 to 700 basis points over market numbers. So we'll continue to gain market share on loan growth, but we are not putting any specific number on exactly what our loan growth needs to be.
Well, yes, part of our DPS strategy, if you recall, one of the first things which we said on growth was to increase our deposit base. I talked to you about the fact that we have reoriented the structure on the retail side, and that we have actually carved out a separate part of our branch banking to focus on new customer acquisition. And there is another part which is going to focus on existing to the bank, deepening of the existing to the bank customers. It has just been rolled out first week of April. Obviously, it will take time for the results to come through. I think the confidence we have, someone like Pralay has, that we'll be able to expand our deposit growth on the CASA side, I think is quite high. On the RTD side has been a great growth story for us in the last year. We grew our retail deposits at more than 40% plus, 44% if I recall correctly. So, obviously we've done a great job. We expect to continue to do that as we move forward. But on the CASA side, we have some work to do, and given some of the changes which we have made in our org structure, we believe that you will start seeing better growth coming from Axis in the future. But it will take time. To turn these things around takes some time.
Yes.
Any conversation with the regulator on any proposals that banks that you might have, or what new guidelines or it should look like after the Federal Reserve is scrapped? Any conversation will happen, or what would you like to see?
Well, we would not like to use this medium to talk about what we like to see. I think Reserve Bank of India is thinking through what the new guideline should look like. I'm sure at some stage they will engage with us. There is no formal engagement that has happened at this point in time. So we'll have to wait for RBI to come out. But that does not prevent us from continuing to do the right thing which RBI had proposed in its February 12 circular. So our view of whatever might have happened still remains the same, that I think February 12 circular set the banking system in the right direction. And we should continue to take the lessons which RBI was trying to push for in that circular, and continue to guide our provisioning norms and policies based on that circular, rather than trying to change something, because it fits in very well into our strategy of becoming more conservative.
On that part, if there's a suggestion going by other banks on giving them a grace period of 30 days, to not call it defaulted next day, immediately up to the first paper, not taking the SMA 0 seriously. Do you think it is a good suggestion there to start recognizing?
I don't want to get caught out on this kind of question because you'll all flash it, but as I said, we like directionally what was said in the February 12 circular. We'd like to maintain what was said in that circular. And right now we are not thinking, there's no discussion going on in Axis Bank that we would want some dilution on certain elements of that circular. We're very happy continuing to follow all the guidelines of that circular going forward also.
All right.
Great. Thank you so much. Thanks for coming. Really appreciate it. Thanks a lot.